Hello and welcome back to this course on the theory of commodity spread trading. We've already covered quite a lot of ground together, looking at commodities in general, the technique of spread trading, both the fundamental and technical analysis that we strongly recommend you always undertake every time without fail before you place a trade. We're going to change direction a little in this episode. In the two videos we're going to cover the subject of money management, often overlooked but one of the most important aspects of trading, not only for spreads, but for any type of investment. After all, if you're not going to look after your money and manage it correctly, who's going to do it for you? Okay, so a quick recap. What do we know? In order to trade successfully, we have to identify which direction the market is going to move in. And we've talked about the tools that can be used. But what about risk and managing your investment? There are no tools to help you arrive at a decision on this like there are for identifying and confirming trades. Why do we trade? The simple answer is to make money, whether that is to supplement an income, a replacement for it, or to build a nest egg to allow us to retire early. So it makes sense that in order to increase our capital, we have to know how to defend it. It's very important, and the first basic rule of trading, to build a strategy that is primarily aimed at defending our investment. That's why money management is the most important part of the trading process. If planned effectively and followed relentlessly, a solid strategy can make the difference between a long-term, successfully managed, profitable account or one that within a few months has had the capital drained out of it. It isn't surprising that most successful investors and traders are those that have clear rules, a clear plan and an effective strategy that they always apply when trading. Having these helps to keep the emotions in check. Let's touch on emotions for a moment, because it's useless to hide the fact that we will be subject to strong emotional swings when trading. And that's because of what's at stake. Money. Our money. Adrenaline flows when you trade. That's natural. You can't stop it. It helps to create the highest of highs when you're doing well, but also brings on the lowest of lows when things go against you. You can't prevent it from happening, but what you can do is plan effectively to minimise the strength of the swings and prepare for them. So, now in this, the first of the two videos on money management, we'll look at money covering off position sizing, that is how much capital you should use on each trade, and then move on to the actual amount of capital needed to trade. Money management is composed of two inseparable key areas, risk management and position sizing. The first of these looks at the risks associated with positions taken on the market and what we need to do to reduce it, and we'll cover this off and what can be done to support it later in the video. The second element in respect to money management relates to the amount of capital to invest in each open trade and how best to distribute this across the various assets in a portfolio. So let's tackle position sizing first. A simple rule of thumb is to say that it's always advisable not to allocate more than 5% of available capital for each trade. So if you have an account with 20,000 in it, the simple maths would say do not put more than 1,000 into each trade. As mentioned a little earlier, every trader who makes profit consistently over time follows the rules of money management very rigidly. It's essential to know from the beginning of our trading activities how much of our money we can allocate for each instrument we intend to trade. Think of it this way, your first thought should not be what can I earn, but what could I lose? It is key to think about the protection and conservation of money first, and then, and only then, look at how you can maximise your returns on it. And this isn't just me speaking. All successful traders think this way. It's what makes them successful. Now it should be fairly obvious that within our equity line, i.e. the profit curve, there will always be fluctuations. The dream would be to have a straight line with continuously increasing capital through constant profit. But this doesn't happen. In reality, there will be downs as well as ups. It's the nature of trading. Being totally honest, trading is an activity that also includes losses. Anyone who tells you that they've never made a loss either doesn't trade or is telling a lie. With the right approach and strategy, a clear plan that you rigidly stick to, your equity line will show consistent growth over time. There will be dips along the way. Managing these effectively is as key to profitable trading as making that big deal every now and then. In fact, it's probably more important than that. One of the secrets of successful trading is being good at cutting your losses, identifying when you're going to be hit by that sucker punch. Know when to manage your drawdowns, that's the reduction in your investment, whilst at the same time knowing when to let your profits run. This may sound a little oversimplified or trivial. However, scientific experiments have proven that for most people, the motivation to avoid loss is greater than the motivation to make profit. It's down to the fact that nobody really likes to admit when they're wrong. Another reason to try and keep the emotions in check when trying to mitigate the risks of trading. We must therefore know how to accept and acknowledge the sucker punch when it comes our way. And the key aspect to this is having a strategy, a clear and well-designed action plan to manage your money so that even before the trade is placed, we know exactly how much we can lose. That way we will not find ourselves in trouble when we face negative situations. Understanding how much you can lose, however unpalatable, can relieve the stress when things go wrong, meaning judgment is not clouded and you can continue to trade effectively. So hopefully you will realise the most important aspect of our business is risk control, meaning that our inevitable losses are contained in order to have an equity line without excessive volatility. Okay, back to emotions for a moment and what actually goes on in our heads when we trade. Numerous questions. How much should I invest? How long should I trade for? Or when do I cut my losses? Our mind can be our number one weapon. But if we don't have precise control of our emotions, it can turn into our worst enemy. Now, I'll talk about the irrational behaviour, well known in finance markets, which is loss aversion. It may seem that I'm trying to impart a lot of information on emotions at the moment, and you may be asking the question of how this relates to money management. Well, the information doesn't come from a general hypothesis, but a study by two Nobel Prize winning economists, two researchers who undertook a series of empirical experiments that have shown that for the majority of individuals, the motivation to avoid loss is greater than the motivation to make a profit. And that impacts our approach to money management. This general psychological principle, which is probably connected to some sort of survival instinct, makes us make a decision that would be the opposite to our normal choice, especially when we see that the results relate to losses rather than loss of profit. So you see, our minds make us make completely irrational errors. It's much more logical to try and let your profits run and not the losses. Now, nearly always the first question I'm asked by people starting to trade spreads is the same one. What's the minimum capital needed? It's clear that the minimum capital required in order to operate in commodity spread trading depends heavily on what kind of activity you want to undertake. With a capital of say less than $10,000, you can only really undertake activities that require a very low margin in the region of about $400 to $500. If you want to be able to trade in all commodities, including those of precious metals and oils, or trade into market, you must have higher capital. Now, looking at the first table on this slide, we can see the recommended sizes of trades to undertake based on the capital you have available. Whilst in terms of capital value, the more you have, the higher the value of an individual trade, in terms of percentage of capital, this should be reduced compared to those who trade with a lesser amount in their account, therefore allowing you to diversify your portfolio as much as possible. Looking at the lower part of the table, for those just starting out or more experienced traders with a lower amount of capital, it's recommended you keep to intra-market trades. The simplicity of these serve as a bit of a safety net as your experience and capital increases. As your pot grows, you can begin to expand into intermarket spreads and those trades that will require a higher margin to be paid. Now, we've already said as a rule, we should not risk more than 5% of our capital on any one trade. So if I have a capital with $20,000 on it, 5% would equate to $1,000. My risk, however, is not $1,000. That amount depends on how much I'm prepared to lose on the deal, and that's dictated by where I want to place my stop loss. Let's say, for example, I place a trade and decide to risk $200 on it. That is to say, I'm prepared to lose $200. It doesn't mean I'm placing a trade expecting to lose it. It's just the maximum I'm willing to risk on this one trade. It could be a higher amount. In any case, in order to do this, I need to calculate how far the spread price will move away from the price I traded at when I open the deal. Once I've identified the price where my loss would be $200, I can place the order to close my trade, comfortable in the knowledge that my loss will be no greater than that. Every single trade is made up of a number of elements and considerations. In spreads, as it is in most trades, you must have a sensible maximum monetary risk. This can be managed by a calculated stop loss, which is a price where you close the trade at a loss to prevent a greater loss. But to do this, we need to understand the value of the futures we trade and what the effects of the price movements mean. Each commodity has a minimum price fluctuation called a tick. A tick is the smallest price movement a future of that commodity can make, and each tick of movement is worth a specific amount of money, depending on the commodity being traded. This is called the tick value. So how do we calculate how far a price moves per tick? Using wheat as an example, we can see from the information provided by the exchange that the unit move has a value of $50. A unit move is 1 full point. The tick value is $12.50. From this information, we can work out that a tick is a quarter of a unit, or 0.25 points. $12.50 being 1/4 of $50. Therefore, we know wheat futures move up or down in increments of 0.25 points. You can see from the information shown as well that the tick value and unit move value for connected raw materials such as soya and soya-based products differ. But there are also similarities between correlated products. Wheat, corn and red wheat, for example, all have the same tick value of $12.50. Still using wheat as an example, and the September 14 contract shown at the bottom of the slide, if we purchase the future at 508 and the price moves to 508.25, we would theoretically have made $12.50 if we'd closed the deal there. Hopefully you have begun to understand the importance of having a well-defined and executed strategy, not only in the pursuit of profit, but also as a way to defend the capital you already have. Knowing where to close a trade, either taking profit or when you're making a loss, goes a long way to keeping your emotions in check. Managing your money with a clear and well-organised plan will allow you to trade calmly and build your confidence, and is an approach, dare I say the only approach, that will lead you down the path to success. We've covered a lot in this first video with regards to money management. If you're ready and happy to move on, the next video, as mentioned, will continue to look at stop loss and position management. If you want to have a break, a Kit Kat moment if you like, put the kettle on, sit back, relax and let the information fully soak in. I look forward to speaking to you soon. Bye for now.